Good afternoon, everyone. Welcome to Nova 401k Associates webinar on common 401k plan errors. Today's webinar is eligible for a Texas CPA and ASPA credit. Right after the webinar ends, you will see the survey pop up if you are needing either of these CE. We have also added the slides as a handout. Just click the handout dropdown on your GoToWebinar panel and you can download and save to your local folder. Today's presentation will be presented by our shareholder, Steve Best. And if you have any questions, please type them in the questions box and we will answer them throughout and at the end of the presentation. Steve, please take it away.
All right. Thank you, Jasmine. Good afternoon, everyone, and welcome to this today's webinar. Again, we're going to be focusing today on common 401k plan errors that we see, and also this is kind of a compilation of some of the more common errors that the IRS identifies, as well as what we've determined or seen in our practice on an ongoing basis. So first, a little disclaimer. Everything in the presentation is general in nature, not intended to be substituted for legal or tax advice, and you need to really consult a professional attorney or accountant if you need that kind of advice. Our provider number, if you need CPA credit, is 009820. You need to have registered individually, be present for the entire webinar, and then you'll be sent an evaluation form afterwards to turn in, and then we'll send you out your certification within a week. So a few items on the overview here. First, we want to learn how to identify who is a fiduciary in this plan or in your plan and who's not. We need to be able to identify some of the more common administrative errors, how to avoid these mistakes, and then there's always corrections that can be made to the plan to fix these common errors. I always like to have a slide here on some of the different roles in the model that we use here at Nova for your plans. Again, it is a team approach, and in any 401k arrangement, there are typically 4 distinct roles to be played. The one that I don't have on here is yours as the plan sponsor themselves, but the team that services your plan needs to have an investment company. That's the investment provider, whether you're with Empower or John Hancock, Mass Mutual, Voya. We deal with quite a few partners, and then you need to have some company that handles the compliance work, right? These plans are heavily regulated by both the Department of Labor and the IRS, and that's where Nova comes in. We're the TPA or the third-party administrator. We prepare your annual required testing. We'll help you with your plan design. We also make sure your plan document is up to date with all current legislation coming out of Congress. We help you in certain cases with loans and distribution review, and then there's an annual government form that has to be filed, the 5500 form, every year on each 401k plan. And finally, because Nova and your investment provider can't really provide specific investment advice, you're typically going to have an investment advisor on your plan as well, and they're there to help your participants with enrollments, answer questions about the investments and the investment lineup in the plan. Quite often, they're helping you with your annual reviews for your fiduciary review to look at the fund lineup to make sure the fees are in your plan are reasonable, and they can also provide specific investment advice to your participant population. Okay. So why is this webinar today important? What we found are that although you see a lot of correspondence about fiduciary liability regarding the investments in your plan, the funds and whatnot, what we actually find is that more money is spent fixing operational problems in the plan than investment-related losses, especially in the smaller to mid market that we work in. And so, if the company has to pay penalties, it's usually going to be regarding these types of administrative errors. And keep in mind that the fiduciaries that we'll talk about in a minute do bear personal responsibility for fiduciary breaches. Now, not all the errors that we're going to discuss rise to the level of a fiduciary breach, but some could. And so, again, part of our job here is to try and keep you out of trouble with the IRS and Department of Labor and avoid all the types of errors that we're going to be talking about. Specifically also the government, the DOL, as well as the IRS has initiatives where they come in and audit the plans, and they're looking for late contributions or different types of defects, and they can impose significant penalties. These are just some of the annual numbers from last year that had to be restored to plans around the country. Also, the IRS specifically has increased the penalties for some of the errors that occur in 401k plans by like a factor of 10 in the last year or so. Just to give you an idea, like if you were late filing your 5500, it used to be a $15,000 penalty. Now they can impose up to $150,000 for each year. Okay. And so similarly, some of the other older penalties that they could impose have all increased significantly. In terms of fixing errors, pretty much just about any mistake in a 401k plan can be fixed. Some can be self-corrected under the IRS's self-correction program, which is part of their employee plan compliance resolution system. Some require a formal filing under the voluntary correction program. And then the last step, which you really don't want to get involved with, is what they call Audit Cap, which is if you basically go into that segment of their correction program. If you happen to be unlucky enough to get audited, randomly by an IRS auditor, and then they find some major problem with your plan, which again, we always want to try to avoid. But pretty much anything can be fixed under that program. It's just a matter of how much is it going to cost. To use the VCP program, this is where we actually file something formally with the IRS to fix a more significant issue. The user fee for the IRS is just based on the size of the assets in your plan. So any plan that's 0 to 500,000 is going to be $1,500. Most plans fall, at least that we deal with, fall into the 500,000 to 10 million range. So if we had to do a VCP filing, your company would have to pay $3,000, not including what the work that we have to do to fix the problem or any corrective contributions you might owe to the plan. This is just the fee to file, and then $3,500 for 10 million and up. So who is a fiduciary in your plan? And there's three types under ERISA law. We're not really going to deal with the first two, which are investment related, the 321 and 338. What we really want to focus on in this presentation is what we call the 316, or the plan administrator. Like, who is the plan administrator of the plan? Okay. Now, fiduciary is basically any individual or entity who exercises any discretionary control over the plan administration or the plan assets, or renders investment advice to the plan. Okay, so it's this idea of who's really calling the shots in the plan, right? Now, examples of types of fiduciaries, because there are many, right? Your investment advisors are going to typically be a fiduciary because they are rendering investment advice in many cases. The trustees of the plan are definitely fiduciaries. The investment managers that manage the funds inside of the plan are also fiduciaries. If you have an administrative committee, not all plans do or companies do, that makes decisions about the design of the plan and different plan matters, whether it's fiduciary reviews or whatnot. But all the members of the committee are going to be fiduciaries. Okay. The actual plan administrators, the day-to-day contacts at the company that are approving loans and distributions, individuals, and of course, anyone who selects any of the above, which are typically going to be the management and the owners of the company, even though they don't deal directly with the plan, they're going to be fiduciaries as well. All right. So getting back to the plan administrator, the 316 fiduciary, this is basically an individual who is a plan administrator. They're typically not going to be named in the plan document, although they could be. So most plan documents don't name specific people as the plan administrator. So when that happens, if no person is named, then the plan sponsor, the company, and whoever is designated to deal with the day-to-day plan administration is the 316 fiduciary. Okay, that's the person that, again, is going to be pressing the approve button for loans and distributions. If, again, under the type of arrangement, investment arrangement you have, you may or may not be doing that. I mean, some companies will approve loans and distributions, but many don't. There's usually a button that someone at your office has to press to approve the loan or the distribution, and then the check gets cut by the investment provider. So again, what are some of these duties? Whether you are aware that you have responsibility for some of these or not, these are typical duties of the plan administrator that is someone at your company. So distributing annual notices. Some of these are sent out by the the Voyas and the Hancocks of the world, but not all of them. So the summary annual report, I'm not going to go through all of these, but this is just kind of a list. The summary plan descriptions are the layman's explanation documents of the plan. They basically explain what the rules of the plan are and the provisions. These, I want to stop on these for a second because these are typically not sent out as part of your enrollment materials, no matter who you're with. Okay, and NOVA does provide a summary plan description, an SPD, to your company whenever we send you a document that's either been amended, or if you come to us and you're brand new, we convert you to our template document. We always provide a summary plan description along with it. It's actually your responsibility to pass those out to your existing eligibles and any new hires that become eligible in the future. All right. A lot of people think that this goes out with the enrollment materials, and it does not. So in almost 90% of the cases. So just a word to the wise on that. All right. So again, part of your primary duties as a plan sponsor is to make sure that you're enrolling your newly eligible people on time. You're sending in the contributions to the investment companies. Filing the annual 5500. We produce it, but you guys actually file it. So just moving along. So we'll get into now specific errors that we see and that the IRS sees. So one of them is the failure to amend your plan document to keep current with all law changes coming out of Congress. All right. And we do help you with this. This is just more information for you. But since we keep track of your document and make sure that we send out amendments to you whenever they're necessary, like required amendments from the legislative bodies. But again, there's a requirement that you keep your document up to date. Sometimes between major restatements, as we call them, these are major updates to the template documents that basically all providers use, is not just NOVA, but the IRS has what we call pre-approved template documents. And about every 6 years, they come out with brand new ones and require everyone else to update to these new template documents. And they're required updates. In between, sometimes there can be interim amendments. Last year we had the CARES Act and the Secure Act. We haven't actually, the IRS hasn't released interim amendments for those two, law changes, but they will, and we will be providing some of those to you for signature. Again, NOVA does monitor this and make sure that we're sending things out, but it is your responsibility when we send out amendment requests or updates to your document that they be signed in a timely manner. And of course, we give you all the deadlines, but this is one of the more common errors that we fix when we take over plans. We find that, new plans coming to us are on a document that has missed a restatement, a major restatement, or is missing amendments because they can't find their signed amendments. So this is fairly common. Just a quick example, one of the interim amendments from 2008 was called the 415 Regulations Amendment. And in this example, if an attorney or another company uh, sends an email or an amendment to you for signature, but somehow it just ends up unexecuted in someone's drawer, then that requires a VCP filing, which we saw initially is going to cost $3,000 just to file, and then we have to prepare the amendment and deal with the IRS, which costs a little bit more. So it's fixable, but if you don't meet certain amendment deadlines, it's going to cost the company money to fix it. So the plan's not going to be disqualified, but it just draws money. So another one, common error is the failure to sign up all of your affiliated employers. So keep in mind that these template documents that we have, there's one main plan sponsor, and if you have more than one company, which is in your related group, maybe you have subsidiaries or whatever, but different EINs that you're paying people out of that are part of your common group, then only the companies that are actually signed up for the plan are eligible to participate in it. So if you have more than one company and you're letting people participate, but you don't have this participation agreement attached to your legal plan document, that's a problem that has to be fixed. Okay. So just to give you an idea of what am I talking about when we talk about related groups, you've got two different types. You've got control groups. And generally, two companies are in a control group or a related group if one company owns 80% or more of another. Okay? If it's ownership by individuals, we call that a brother-sister control group, and that is essentially when the same 5 or fewer partners or owners own at least 80% of more than one company. Okay? So how do we avoid, again, this error of updating your document in a timely fashion? Just make sure you're reading all of the correspondence from NOVA. We do send out emails whenever required updates happen. In fact, we're going through a major restatement cycle right now, just to let you know. And so you will be seeing from our documents team emails, and they generally are going to be going to the trustees of the plan, but if you're the primary contact in your plan, you'll be CC'd on this. But we're going through a major restatement cycle where we have to update to these new template documents that have been released by the IRS. And so you need to pay attention to that correspondence coming from us and the deadlines on which, on when to sign. You may not have seen an email yet from us. Don't worry about that. We have quite a few clients, so if you ask for a discretionary amendment, we're going to put you on the new document and get it all done in one go. But if you haven't asked for an amendment, we're just kind of working through our client list or our book of business in a ratable fashion so that we get it done by the deadline, which I think it's the end of next year, but they might have extended that. So there's plenty of time. Just keep an eye out for on your emails for something like that. Also, in terms of your related group employers, it's very important that you contact us anytime you're being acquired or you're thinking of acquiring a company. This can have significant consequences to the plan, and you do get some, some period of time in which to work it out, but it's much better if we can know about it in advance so we can consult with you on what the best practices are when you're going through an acquisition. All right. So another common error is failure to follow the provisions of your plan document. So the IRS requires that the terms of the legal document actually be followed in practice. And whenever you don't do that, that's what we call an operational error, right? And it could result, if it's bad enough, it could result in complete disqualification of the plan. But we'll go through some examples here in a minute. But this is very common, like knowing what is in your plan document and following it in daily practice. So an example of that is the failure to follow your plan's definition of compensation. This is probably one of the most common issues we run across. So in your plan document, it defines what compensation should be used when you apply both the individual's deferral or contributions elections and also how we compute, or how you compute if you're doing it payroll by payroll, your employer contributions, whether it's a match or profit sharing. There's a specific definition in your plan document. Okay, and if you're not following what's in the written document, or applying that in your payroll system properly, then it's going to result in participants getting the wrong allocations. So most plans, just so you know, do define compensation as total gross W-2 pay. All right. You can exclude bonuses, commissions, overtimes, and things of that nature, but it has to be in your plan document. And in many cases, we at Nova have to do extra non-discrimination testing if you're having some of these, I wouldn't call them rare, but non-routine exclusions. All right. So if you're ever thinking about, whether you're following the right definition of comp and what it is in your document, just talk to your Nova account manager. They can always look at your most current document and tell you what your definition of pay is. Then you can compare it to what's in your payroll system and see if that's what's happening on a payroll by payroll basis. So for example, right, if you have a matching formula and you've got a payroll system that's set to calculate the employer match using base comp, right, which excludes overtime and bonuses, and your document, doesn't indicate that that's an exclusion that you can use, then a lot of people have been shorted, right? If the definition is gross and you're using base in your payroll system, you're probably going to be able to fix this with a self-correction, meaning you don't have to do a formal filing. But if you can imagine, you've given people too little according to the document, right? And you haven't allowed them to put in their own contributions based on the bonuses or whatever you've been excluding. So it's a problem that has to be fixed. Again, we avoid this by making sure we understand what your legal document, how it reads and what the provision is for the definition of comp. And if you're not sure, just call us. We'll let you know. Also, if you have personnel changes or you're changing payroll systems, we find sometimes this can get out of whack when there's a change like that. So it's important to just make sure that you're training your new folks. If you have new HR people come in, but especially if you're changing payroll providers, that they understand, what the plan provisions are and that we reviewed them at that point. So failure to apply the plan's initial eligibility provisions properly. So this is about letting in your people in a timely fashion into your plan. All right. So the thing to keep in mind is the plan document and the waiting period that's written into your plan document is all that matters. It doesn't matter what your offer letter says or what your administrative policy is in your company. None of these are going to override the plan. So we've run into some situations where individuals have been promised entry into the plan early, for example, in an offer letter, but that's meaningless to the plan. They can't do that. There's a way to get around that, but it has nothing to do with the offer letter. So again, employers, it's very common for people not to be offered the plan on time. And sometimes you have the reverse. Sometimes people are let in early, right? So you're letting ineligible people in. Again, problems to be fixed. So for example, if you have a plan with no age or service waiting period, but you hold out a participant for 6 months, well, what do? The company is going to have to make Steve whole by making an employer contribution for the missed deferrals and the match if you were making a match, right? Like you've got a match going to everyone else, he's got to be made whole for the match and a portion of the missed deferral that he would have had you let him in on time. So just so you know, the waiting periods in 401k plans do have a maximum wait. So we've got 1 year and age 21 with 2 entry dates being the longest you can hold out an employee. And typically a 1 year wait means that you had to have worked 1,000 hours in the initial 1-year eligibility period. We'll show an example of how this works, just so everybody understands. The age requirement cannot exceed 21, so you can't have a 22 or 24 age holdout requirement. And the initial eligibility period, or the initial computation period, is the 12-month anniversary date from the original date of hire. And then that typically is going to shift to the calendar year after that. Now, just so I know that sounds odd, but here's how it works, right? So for those of you that have a 1-year wait and a 1,000-hour requirement, which will be just about anybody that has a 1-year wait, if you have an employee that hires on 6/1 of 2019, how do we compute when they're eligible? You go to the 12-month anniversary date, which is 6/1 of 2020, and you ask the question, did they work 1,000 hours in this computation period? All right. And if the answer is yes, and you had 2 entry dates in this case, right, then you would offer this person the plan for pay periods immediately after 7/1/2020. All right. Now, if the answer is no, like they worked 500 hours in this initial computation period, then the next computation period is the following calendar year. So basically 1/1/19 to 12/31, or I guess 1/1/20, excuse me, to 12/31/20. You'd ask the question again, did they work 1,000 hours in that period? And if you've got somebody that's consistently working below 1,000 hours and you have a 1-year wait, they'll never get into your plan. But you need to understand that the first computation period is always going to cross a plan year like this. It's required to be the 12-month anniversary date from the initial date of hire, the original date of hire. So just so you know how to compute it and let your people in a timely way. Now, shorter periods are okay. Yeah.
We actually have a couple questions submitted. Do you have time for those?
Yeah, sure.
Okay, so the first question, I'm new to the reporting function at my company. Do you have a calendar of the reporting requirements for 401k contributions, distributions, etc.?
Like some of the deadlines, you mean? I assume we do have some worksheets on what are some of the more common deadlines. A little later in this presentation, we're going to go over some rules on, how soon you have to send in contributions and things of that nature. So yeah, we have, a variety of, little training guides. We also have many other webinars, including this one, where we talk about, loan and distribution processing. If you go to our website, which will be at the end of the presentation, you will be able to see some of the upcoming webinars, and then we also have them recorded as well on various topics, because as you can imagine, the administration of a 401k plan has a lot of moving pieces. So yeah, so contact your account manager and or me or Jasmine after this, and depending on what you're really looking for, we can try to get you the right information. So.
Sounds good. And then our next question, they were referencing slide 27. Wouldn't the entry date make a difference? Like if they have immediate eligibility, but entry is semi-annual or monthly, the employee can enroll but cannot start participating after the entry date is reached, correct?
Okay, yeah. So these plans, you have a waiting period, and then you have the entry dates, okay? And they can all be different. Like I'm showing the maximum, right? Like for 1 year and 2 entry dates, if you're a calendar year plan and you got a 1-year wait and 2 entry dates, your entry dates are always going to be 1/1 of each year and 7/1, right? But the entry date matters, right? Like in this example, the person became eligible on 6/1/2020, but the next entry date falls later. So you don't actually have to offer them the plan until 7/1. Right. And again, these entry dates are there simply for your administrative ease. You can have entry dates or you could have immediate entry, right? Which was the next slide. I was about to say, shorter waiting periods like 3 months or immediate entry are perfectly okay. We have plenty of plans like that. But whatever your waiting period is, whether it's 3 months, with quarterly entry dates, if you've got a 3-month waiting period, you have to basically 3 months is even easier. You don't have to worry about hours. You can't use hours when you have shorter waiting periods than 1 year. So if you have a 3 month wait, you simply, from the original date of hire, you go to the 3 month anniversary date and you ask the question, is the person employed on that date? And if the answer is yes, they get the whole 3 months. That's the service spanning concept. They could have worked 1 day at the beginning on their original date of hire, terminated, and if they come back within 3 months, they're in. Now you do have to wait for the entry date, so it would be, you would let them in on the entry date following completion of 3 months or 90 days, whatever your plan says. Okay, so you can see that shorter waiting periods are not effective for keeping part-time employees out. There's no hours requirement. If your plan's not excluding part-timers, which is generally not permitted, this is not going to keep part-timers out. The 1 year wait might, because a lot of part-timers are never going to work 1,000 hours in any plan year. But these shorter waiting periods should apply to everyone. Okay. So now, I mean, that kind of leads now into excluding certain classes of employees. We see this problem all the time. We'll have a plan sponsor that's excluding hourly employees. Well, that may be okay. It's subject to some additional testing if you're doing it, but your document has to say in it that you're excluding hourly. It has to be an excluded class written into your document. You don't get to just do it at the employer level, right? Another example is, and this is very common, we're excluding our part-time or seasonal people. Well, the IRS does not like the term or the exclusion using terms part-time or seasonal because they feel like this can be a circumvention of the 1 year wait. You can have a lot of part-timers and seasonal people that work more than 1,000 hours, right? So they view this as a gimmick, that employers can use to keep people out of their plan that are otherwise eligible under the 1 year wait maximum, right? And so generally, you don't have these exclusions in your plan. There is a way to have it and work with it, but it requires a lot more calculation on your part. So if you're excluding part-timers and you're, like I said, in most cases you don't have that exclusion in your plan document, I would call your account manager and we need to probably talk about it. All right, so just be aware of, in terms of avoiding, and being able to let people in on time, you need to be aware of what is your waiting period and what are your entry dates. That's key, obviously, right? And then how to compute when somebody becomes eligible. All right. There are, if you happen to be feeding all of your payroll data to, let's say, a Hancock or a Voya, some of them are able to calculate this for you, but that's pretty uncommon because it requires you to give them all of the data on your folks all the time, right? And most employers are only giving data to the investment providers on the people that are contributing, so they're not doing eligibility computation for you. All right. Also, don't be excluding any classes of employees unless it's allowed in your document. So if you don't know if it's allowed, you need to contact us and ask, and we can look. All right. Also, it's good practice, in case you get audited, to collect, if somebody declines participation, like I don't want to participate, or I want to have zero election, collect forms on that, right? Require them to turn in a zero deferral election, right? And keep it on file. Because one of the things that the IRS does look for when they come into audit, and we do help with a lot of audit coordination like that, they are looking specifically for people that have been excluded improperly, right? And if they usually want proof that you've been offering the plan in a timely manner to all of your people. And if you can provide forms that say, look, here are the people that elected something and I got zeros on the rest, then that's what they would be looking for. We get a lot of questions about dealing with rehires. So what do we do there? If the thing to keep in mind here, it's a lot simpler than it probably reads, but If a formerly eligible employee ever had a single vested dollar in your plan in the past, okay, they never lose their prior service credits. So just think that includes their employee money, right, which is always 100% vested. So if they contributed in the past or they got any employer allocations that were vested, even 20% or partially, they never lose those prior service credits. So what you end up doing is you should offer them the plan, or allow them to start participating again as soon as they rehire. They don't need to requalify under your waiting period. You don't need to hold them out until the next entry date. The minute they come back, just say, you're eligible for the plan. Here's your enrollment materials. Give me your forms back, right? Now, if they never had a single vested dollar at some point in the past, then they will lose their prior service credits after 5 consecutive one-year breaks. So if you think about that, it's really going to be pretty uncommon for somebody to lose their prior service credits because, how often do you go back and rehire someone that was eligible, never contributed, and has been gone for 5 years, right? And now you've rehired them. It can happen, but it's pretty rare. So vesting versus initial eligibility computation, right? There can be confusion here. But like I stated before, for initial eligibility or your waiting period for new hires, right, you have to start with the original date of hire, right? So that first computation period, whether it's 3 months or 1 year, starts from the original date, not a rehire date, and it's determined there. Vesting, which again, we help compute this. You don't have to compute the vesting. But vesting is done on a plan year basis, and most plans are calendar year. So, when you're looking at how vested somebody is, again, this is, for the employer money, how much of that employer money do they get to take with them when they terminate and leave the company? That vesting is determined on hours, so we'd be looking at 1,000 hours in a calendar year. Did they work 1,000 hours, yes or no? If they did, they get a year of service credit. All right. So there's not this cross-plan year concept for that initial period. So service crediting, again, year of service accrual requirements for your employer contributions. Additional requirements can be put on the employer contributions. So even though somebody is otherwise eligible, they met your 1 year of service or 3-month initial eligibility and they're in the plan. Some plans can also require additional hours. So for example, you need to have 1,000 hours to get the profit sharing contribution for a specific year, or you need to be employed on the last day of the year in order to get the match or the profit sharing. There can be additional requirements in the document for getting a specific year's contribution. So don't confuse those. Again, this is not something you necessarily have to worry too much about. We keep track of this when we do your annual allocations. If you're doing any annual allocations, a lot of plans are doing payroll by payroll, so you're not even affected with this. Okay. Loans, very common in plans. Again, there can be loan failures in plans. Most loans, by the time Nova reviews the loan, and also your investment providers have systems that keep track of what these maximums are. But just to educate you a little bit, loans do have a maximum dollar amount. We'll discuss that in a minute. They have to be on certain amortization payment schedules. And a lot of the failures, probably the most common failure we do see is that somebody takes a loan and it's missed in payroll. Somebody doesn't get loan payments set up in payroll on time, right? And then we're stuck in having to fix the loan and get it back on track so it gets paid off. So what happens, right, if you miss loan payments? There is a certain cure period that the IRS mandates. So if a delinquent loan has to be fixed no later than the quarter following the quarter in which the first payment is missed. All right, we'll have some examples of this in a minute. So anything that's not fixed within this cure period has to be defaulted, right? And what does that mean? The IRS requires that the loan be taxable, because a loan is something that people get money out of the plan. It's not a taxable distribution. They repay it back, right? And there's no tax penalty or early distribution penalty. However, if loan payments are missed and you don't fix it, it does become taxable and subject to penalty. And so if it's not fixed within the cure period, you gotta go and tax that loan now. Something to keep in mind, a lot of your investment providers are not going to tell you when a loan is delinquent, right? But they do send reports. Many of them send reports that, hey, here are the list of loans that have not received payments in the last quarter or the last few weeks, right? So keep an eye out on your message centers, with your investment providers, whoever they may be, all right? Because most do not default these things automatically and keep track of this cure period. Some do, but not most. So what are some of the ways to fix a loan within the cure period? You can either catch up the missed loan payments, right? The whole idea is that, whether a loan was taken for 5 years or 3 years, you're really supposed to keep the loan from being taxable. You're supposed to get it paid off by that maturity date. So when you miss payments, you got to get the loan back on track. And you can do that either by making up some of those missed payments. The individual could pay off the loan completely. That would be fine. But again, most people are not going to do that because it might require quite a bit of money. Or the loan can be reamortized. So, at Nova or at your investment provider, a new amortization schedule is drawn up. The payment goes up a little bit more so that it's paid off by the maturity date. Now, after the cure period ends, I need to update this slide. It used to require a VCP filing to fix a loan that was outside of the cure period. They've actually updated the VCP program now to where you can self-correct this problem. And again, what would the correction typically look like? So even if you're beyond, like, let's say 6 months, you're generally going to be able to reamortize the loan. But the key is to get it fixed. All right. So an example, if we have a plan and a participant takes out a loan, but the administrator fails to set up the loan repayments and payroll, and the participant doesn't make arrangements to make the payments, several months go by, and oops, we've got some missed loan repayments. If you don't fix the loan in a reasonable amount of time, then it really needs to be defaulted and considered taxable income. And it could be, if the person's under age 59 and a half, it'll be subject to an early 10% withdrawal penalty as well. Now, the maximum loan amount that anyone can take, even if you have $1 million balance, is $50,000. So in this example, if we had a participant that took out 60, then that excess amount of 10,000, right, would be considered. Well, I've got another typo here. I need to adjust that, but the 10,000 would be considered taxable. So the excess amount. Now, how do we avoid these problems again? Make sure you're monitoring your message centers by your investment providers. They do have loan reports. I would definitely compare some of these reports on who has outstanding loans to who's set up to repay loans in payroll. All right. Now, keep in mind, obviously, people that are terminated and had loans are not going to have repayments in payroll. However, we do need to identify who's terminated because their loans, if they don't pay them back before the cure period is up, technically the loans have to be defaulted. If the person takes a distribution of all of their other money, the loan automatically gets defaulted. So you don't have to worry so much about those. But the people that leave their money in your plan that had loans, those are the ones you're typically going to want to look for to see if the loan is missing payments, which it will be, right? They terminated and you cut off the payments. So the next step would be to default the loan. All right. We try to, We do this in our plan documents, but just to ease your administration, the loan policies that we set up for you only allow for one loan at a time, which hopefully simplifies payroll and how many loan payments you have to set up at any one time for one person.
Excuse me, Steve.
Yep.
We did get a question regarding the loans. They asked, what if an employee with a loan is on a commission-only payroll and doesn't have a commission for over 3 months? Will it automatically be considered taxable and the employee notified?
Again, there's not going to be any automatic notification typically to the employee at all. And the loan, again, like I said, most investment providers are not going to automatically default any loan. That's part of your job to typically there's going to be paperwork that would need to be filled out. But in that particular situation, what you'd want to do is if they've missed a period of payments, right? So if the amortization schedule, which all of these loans have, they're typically going to be based on whatever payroll cycle that your company is on, whether it's weekly or biweekly, et cetera. If they've missed payments, you need to contact either Nova or your investment company and get the loan refinanced, right? Because if you've missed like 3 months worth of payments, that loan is never going to get paid off by the maturity date. And so, yeah, I mean, commission onlys with large gaps of time are going to be pretty difficult to manage because, I mean, you don't really want to be refinancing the loan every 3 months if they're only paid that often. But you do need to you have to make arrangements to make sure that the loan is paid off by the maturity date. That's what we mean by curing the loan, or the shortfall in the loan payments. Any other questions at this point?
We did have one other question about, can you exclude temporary positions such as summer laborers?
You can. So having an exclusion in your plan that's not service-based in the way you describe it, right? Like summer help, or you don't want to use the terms temporary or part-time. IRS doesn't like that, but so long as you give them a category, whether it's interns, you can exclude people from your plan. There is a limit, just so you know. It's about 30% maximum of your eligibles, right? But so long as there's only a few people, you can put an excluded classification, whether it says field workers or interns, something that you can identify easily, right? That's not service-based in the way it's described, is okay. But we have to write it into your document. That requires an amendment. So contact your account manager for that. Now, another thing that we correct a lot. I mean, this is the most common problem. Getting the employee contributions from your company's bank account over to the investment providers or the trust company for your plan. Okay, the DOL has rules on how quickly that has to happen. Small plans have what we call a safe harbor time frame. So long as if you're a small plan, which means you have under 100 eligibles in your plan, okay, then you have 7 business days to take the employee contributions and send them into the investment company. 7 business days. If you miss one pay period, like I'm 9 business days on one, you can revert back to what the large plan standard is, which we'll go over in just a moment. So just keep in mind, a lot of our plans are small, so you need to get those contributions, into those record keepers, those investment companies within 7 business days, or they're late. And what happens when they're late? We need to, Nova is going to have to charge you to do a lost earnings. You're going to owe earnings on the late period. Okay. Now, again, keep in mind, this is only the employee contributions, not the employer contribution. If you're doing a match or whatever, typically you're going to send both in at the same time if you're doing payroll by payroll. But technically, this late standard only applies to the employee pieces, whether it's the contribution or the loan repayments. All right. Now, large plans are on a different standard, and basically, it's as soon as administratively possible. there's this in the regulations it says, but not later than the 15th day of the month following. You can forget about that one. The DOL has already indicated that their standard really is as soon as administratively possible. So what does that mean? That means that it's kind of a gray area, but they would look at your other plan, not plan, they would look at your other operations, like how soon are you sending in the federal withholding on the same pay period? You know, did you get all of your contributions in within 2 days? And you've got a couple that are 5 or 6 days, right? So it's a facts and circumstance determination. In general, what we found, because we deal with a lot of DOL auditors too, they're going to give you about 3 to 5 business days, max. That's it. Okay. So this is, if you're a large plan with more than 100 people, your independent CPA that audits your plan, they look for this. It's almost exclusively what the DOL looks for when they come audit you. All right. So, for example, we have a company that fails to deposit employee contributions for a pay period until 3 months after the deduction date. Well, again, what happens? You owe lost investment earnings on the late contributions, and depending on the amount involved, then you may have to pay an excise tax penalty as well, because those are considered prohibited transactions. The sad thing about this, I'll tell you, because we have to fix a lot of these at our company for employers, the amounts involved, the lost earnings, can be very small. You're supposed to fix them, and you have to fix them, and the problem is we may have to charge you $200 or $300 for to do the calculations, which are fairly complicated, which only come out to like $50, right? So that's the bad thing. We have to charge you more than the fix sometimes just to get it done. So how do we avoid this? Again, just make sure you understand what your applicable deadline is. Is it 7 business days? Is it going to be 3 to 5? And you want to set up procedures to make sure that those employee contributions for each pay period are getting in within that time frame. All right. And if you need backup procedures for anybody that might be out on vacation or sick leave. And if you're running multiple companies and multiple payrolls, make sure you check all of those. And this last bullet is especially important, for large plans especially, right? Because it's a gray area. Be consistent, meaning if I'm going to get my contributions in within 2 days, get them all in within 2 days, right? Because again, DOL, if they were going to come up with what standard applies to you, they're going to look at, well, 50% or 90% of all the pay periods were done in 2 days, and here we have these outliers that are at 7 days. They're going to consider your standard to be 2, because it's like, well, you got almost all of them in within 2 days, and the others are late. So just be consistent. We also correct a fair number of deposit errors. So within these 401k plans, you're required to put the money into the correct bucket, if you will. So when you look at your benefit statements in a 401k plan, they're going to have multiple line items. You've got a line item for your employee pre-tax contributions. There's a separate one for Roth, because those are after tax. If you're doing a match, there's another line item for match. You're required to keep these sources separate, right? Because some are subject to vesting, some are not. There's different distribution requirements for some of the sources. So sometimes we'll see employers deposit when they make a switch, let's say from a regular match or a discretionary match, and they start making a safe harbor match contribution, which has a different vesting requirement to it. Again, this is just a plan design change, but what happens is whoever's sending in the contributions just on autopilot, and they send the safe harbor match into the matching source, right? Again, safe harbor match is 100% vested, match is subject to a vesting schedule, and if you commingle the sources, people are going to be paid out incorrectly when they go to take their money. Again, this can cost the company a fair amount of money if it's done for long enough, right? Because people can be underpaid, they can be overpaid. So again, a typical error occurs when a plan goes from, let's say, safe harbor match, and then goes and deposits all the safe harbor contributions to the regular matching source, because whoever's sending them in is not paying attention, right? So again, that's going to require a fix. We're going to have to move the money around and do calculations on earnings to get the right amount moved. And again, we have to charge for that because it's non-routine work and can take quite a bit of time to fix. So some of the limits in 401k plans, I know I'm kind of running a little short on time here. I'll try to go quickly. Again, you need to be limiting the employee contributions and the match to certain limits. The employee contributions for 2021, if you're under 50 years old, is $19,500. Okay. Anyone that turns 50 or older at any time this year can put in a total of 26. All right, and you don't have to have a separate field for the catch-up, as we know at the $6,500. You don't need a separate field in your payroll system for that. Just set up the limiter in your payroll system correctly. If they're under 50, it's $19,500, and the system cuts off the minute the person hits $19,500. And if they're 50 or older this year, it's $26,000. Right? Now on the match, this is one that gets people quite a bit. 401k plans and the IRS has a maximum compensation limit in a plan. All right, and that limit for 2021 is $290,000. So it doesn't matter if somebody's making $500,000. All the limits and all the contributions that we calculate have to be limited to $290,000. So what does that do? If you happen to have a matching formula, let's say a 50% of the first 6, right? Then the maximum match that anyone should get during the year is $8,700, right? And we arrive at that by taking the 290 times 6% times 50%, right? So depending on your matching formula, your limit's going to be a little different, but it's important in payroll that you just set up a limiter for the match as well. And again, when somebody hits that limit, if you're doing payroll by payroll, it just stops. It stops the match right there. And then you don't have an excess. Now, what happens if you have an excess? It's not the end of the world. NOVA, when we get your annual census, we do look at this limit. It's just that we may have to end up taking money, like maybe you had a highly paid person that got $10,000 in this case. We're going to have to take that excess and transfer it into your forfeiture account. So we're taking it out of his account, and that might make that person a little unhappy, right? So it just, having a limiter in your system to begin with just cuts down on the need for fixing problems. So something. Now, the worst case scenario would be you put $10,000 into somebody's account by accident, then they terminate, take their money before we get to catch it, right? Because we only get your annual census. We're not even looking at this limit until, the first quarter of each year for the prior year. If somebody happened to terminate and you overfunded their account, they're going to take your money with them, and you're probably not going to get it back. I won't go through this example. This is the safe harbor example, but I know we have a lot of safe harbor plans. So your match caps out at 4%. So again, if your basic safe harbor match, $11,600 is the most any one person should ever get in the match. All right. So again, just make sure in avoiding these that you're updating your dollar caps in your payroll system for both the employee, and employer contributions, and make sure that your catch-ups and non-catch-up contributions, right, are added together for calculating your match, right? You don't have a separate field for the 19.5 and a separate field for the 6,500, and then you calculate the match separately for each. You want to add them together, divide by the person's pay period by pay period comp to come up with what their contribution rate is, and then you apply your match to that rate. Otherwise, you'll overfund the match again. All right, so we're almost out of time. I'm going to skip through a few of these slides. If you have forfeitures, I'll mention this. So forfeitures are the non-vested piece when somebody takes their money and they're not 100% vested. Money transfers into your holding account or your forfeiture account at your record keeper. These forfeitures can be used to reduce expenses, or they can kind of reduce your ongoing employer contributions, right? But the one thing you never want to have happen is you never want to have a check come out of the forfeiture account back to you as the employer. This is a prohibited transaction, so just keep that in mind. So I'll just finish it off with, again, you can see there's a lot of administration that you have to do as the 316 administrator. In Nova, we prepare things for you, but we're not signing anything, okay? We don't sign the 5500. We don't, on your loans and distributions, we're typically not signing those. So we are not actually the 316 administrator. You are. But you can also, just like you can outsource HR and other functions in your company, you could hire a professional 316 administrator to take over certain functions that you have to do, right? And this would save you internal staff time. Again, a lot of times even if you have a fairly large HR department, they still don't understand all these complicated 401k rules. So if you want to, again, this is just explaining that, Nova and also John Hancock and Voya, all these people, they're not the 316 administrator. You are. All right. And basically all we're doing is providing ministerial functions, not fiduciary functions. Right. So if you want to hire a professional 316 company, the ownership group at Nova did create a separate company that provides these kinds of services. Things basically taking over a lot of what you do on a day-to-day basis or have to do, that could be taken over, and they'll accept the fiduciary liability. There's different levels. Again, I'm not going to go through all of these, but you can see these are all like duties that you generally are responsible for, and there's a lot of bullets here. But if you want help with somebody else, taking these over as a fiduciary, meaning that if something gets messed up that costs money to the plan, they're gonna cut the check for these mistakes, not you. Just let us know. You can contact Araceli Valdez at that email number if you're interested in a quote for what those services cost. Do we have any more questions at this point?
Yes, Steve, we did get a couple more questions, but I do see we ran out of time. So if you did submit a question and we didn't get to it, we will send you an email by the end of next week with the answer to your question. And thank you to everyone for joining us today. And thank you, Steve, for talking to us about common 401k plan errors. Please note the survey will pop up right after the webinar and for you to complete if you are needing Texas CPA or ASPA credit, so please complete that. The certificates will be sent out in 1 week, and the recording of this webinar will be made available on our Nova YouTube channel by the end of next week. If you have any questions, please reach out to your account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Everyone, please have a terrific Thursday.
All right, thank you.